Let's get in a very important market voice. Pankaj Murarka, CIO of Renaissance Investment Managers, joins us right now on the show. Pankaj, so good having you. Thanks so much for joining in, and happy Navratras to you. Pankaj, I remember a conversation that we had maybe a year and a half back, wherein we had said that don't confuse bull markets with brains. Sometimes you should not argue. Now the markets have given us a reason to sit back and think about what's next. How are you thinking about the current landscape?
Morning, Neeraj. Wish you and your entire team and all your viewers a very happy Navratra and festival season. You're right, Neeraj. What we've essentially seen a complete reversal in the last 1 year, where one earnings growth in India has slowed down. We are in the second successive year of single-digit earnings growth. FY25 earnings growth in Nifty 50 companies or the top 200 companies was about 5%. This year, I think it will be high single digits, but yet a single-digit earnings growth. And last 12 months, all the North Asian markets have done significantly better than Indian markets. We've seen Korea, Taiwan, China do phenomenally well. And in fact, India's underperformance to MSCI emerging markets is the largest or the widest underperformance that we have seen going back to all the way to 1996. So I think all of this is a fallout of the sharp cyclical slowdown that we saw in the economy. But the good thing is that the low point of the economy is behind us. So I think we'll see a gradual building of earnings momentum from here on. And I certainly believe that second half of the year, from an earnings perspective, this year, second half will be much better than what we've seen in the last 6 quarters, actually. So the good thing is that probably the worst of earnings slowdown is behind us. From here on, we are looking towards earnings acceleration. Government has done its bit in terms of injecting fiscal and monetary stimulus. If you add all the three stimulus measures announced by government and RBI, which is the tax cuts and the budgets and the recent GST cuts and the 100 basis points of rate cuts that RBI has done, cumulatively all of this amounts to about $70 billion in terms of stimulus that's been infused into the economy in the last 9 or 10 months, which is like 1.7% of GDP, and which is quite meaningful. I think we will see the impact of this, or the trickle-down impact of this. One will see immediate impact in terms of short-term buying, but I think more importantly, we'll see a more sustainable impact of this over the next 3 to 4 quarters. So I think, meaning after a year of consolidation that Indian markets have seen, valuations have also normalized at 20 times 1 year forward earnings. India is, not as expensive as it was a year back, and now valuations are pretty much in line with long-term averages for India. Given that we're looking forward to acceleration in earnings growth and valuations of normalized from here on, I think we should look forward to some reasonably healthy gains in equity markets from a 1 year forward perspective or next 1 year perspective. Having said that, I still think there'll be a very wide dispersion in sectors and stocks which will perform and stocks which will not perform. So stock selection will become very important.
Pankaj, morning. Tamanna here. Interesting to hear your take on valuations now becoming more acceptable. But is this across the board, or do you still think that there are segments which are frothy in the Indian markets? And if so, where do you see those?
So, yeah, maybe let me just elaborate a bit on that, Tamanna. The fact is that I said, meaning I believe valuations are reasonable, but I'm not saying that valuations are cheap or very attractive. And that's unlikely to be in India's case, because I think globally investors understand that while India has underperformed in the last 1 year, but yet India is the only secular growth story if one were to take a 5 or 10 year view. So in that sense, valuations are pretty much reasonable, but yet India is the most expensive equity market in the world outside of US. Obviously, there are pockets of froth in markets where valuations are far more extended and where earnings will not, keep in line with expectations. And I see some of those challenges more in mid and small cap. So I think one should be very careful in terms of mid and small cap, because there's still pockets of froth where companies are trading at 50, 60, 70 times, 1 year forward earnings for, earnings which are growing in high teens or, low 20s kind of a thing. So I certainly think that those kind of valuations are not sustainable, and which is where one should be careful in terms of what pocket of market or what sectors one would like to stay invested into.
Pankaj, we had a. Um, I'm moving to. Okay, let's start off consumption, and I want a view there. This whole GST piece, wherein there is a definite boost, a play of hand from the government to boost consumption. What subsets within consumption do you believe are best placed to benefit from this, and also might have the right valuations for giving investor returns?
Consumer is a sector. Let me put things in perspective in
Sure.
terms of how at least I'm thinking about it. 5 years back or 6 years back, 2019 and 20, it was the most expensive part of the market. And certainly valuations were two standard deviation above long-term averages. And the sector was coming out of 10 years of bull market. Please remember, bear in mind that 2010 to 2019 was the biggest bull market in consumer that India has seen in a very long time. But now what has happened in the last 6 years, the sector has underperformed and there's been earnings growth. So as a result, valuations, I think, have normalized in the consumer sector. Given the kind of stimulus that has been infused in the economy and the last one being the GST, I see needed very healthy growth across both staples and discretionary because we're coming out of a very sharp slowdown in consumption over the last 8 quarters. So I think, and we're already seeing early signs of recovery in staples consumption, especially in rural India for the last 2 quarters. Rural India is doing double-digit volume growth. And also bear in mind that the slowdown in consumption in rural India started much before it spilled over into urban India. So which is where we're seeing the recovery happening much earlier than urban India. But I think as a consequence of this stimulus, I see recovery in both staples and discretionary. Yet, for investors looking at a slightly more medium-term perspective, I think the growth and the potential returns will be much higher in discretionary consumption versus staples.
You know, Pankaj, I'm just wondering if you are pivoting towards a more domestic stance, considering the global headwinds, the US-India trade deal still hanging out there. We don't know what's happening with the wars, etc. Are you focusing on a more domestic stance and domestic-facing companies right now? Is that a filter you're applying?
Absolutely, Tamanna. I think there is it's very evident we have very strong tailwinds for consumption recovery in the economy. In fact, I can say at about 16, 17% allocation to consumer sector in our portfolios. This is the highest exposure I'm having to the sector after a gap of almost 7 or 8 years after 2016 or 17. Because now I clearly see that we are coming out of a low base. So one, there is a pent-up demand because consumers have underspent in the last 2 years. Because high inflation had eaten into their purchasing power. Now with this stimulus and affordability coming in, and I'm also looking forward to probably my sense is that the next government policy announcement is going to be the budget. I know we're still some time away, but still, I think the budget will be once again be consumer-oriented budget where we think government will do a fair bit in terms of reviving consumption in the economy. And I'm also looking forward to the implementation of the 8th Pay Commission next year, which will lead to a significant boost in terms of income in the hands of central and state government employees and different and allied forces. And generally, we've seen that when 8th Pay Commission money flows into the hands of consumers, they tend to spend because government employees have very high level of job security, so they tend to spend that. So combination of all of this, I see fairly healthy triggers or tailwinds, if I would say so, for a meaningful and more importantly, a sustainable consumption recovery over the next 3 years.
Pankaj, one consumer tech question and then one tech question. Today we had a healthy debate on the channel about the valuations at which consumer tech companies are trading at. Now, and the person doing the argument said that, but there are individual cases of brilliance out there which might continue to trade. Now, we know there are a handful of listed companies out there, right? So the point that I'm making is there is a very small cohort of stocks which you can buy to play consumer tech. Within that cohort as well, therefore my question to you, Pankaj, is this, that within that cohort as well, can you pick and choose, and can one do much better than the rest of the pack? And would you be an investor at these valuations?
Neeraj, I learned something in my early days as a student that there are certain exceptions to law of physics. And so valuations don't apply to tech companies, internet companies, as long as you can pick the winner. Don't fall in the trap of valuation. It's a sector where winner takes all. The two or three companies in every segment and every sector will have 140 or 150% of the profit pool of the industry, because all the other players will keep bleeding. These businesses, one, they're growing fast. More importantly, because of the very high competitive intensity, they're consolidating their segment very fast. I've given these examples a few times in the past. I'm going to repeat that at the cost of sounding repetitive. Think about it as a cement industry. After 70, 80 years, the industry has, we have about 50 odd cement players in India, listed, unlisted. Now, when you talk about food delivery, you're just left with 2.5 players, yeah, and 2 players controlling 120% of the industry profit. So in every segment, in the technology segment, you're seeing food delivery in India is an oligopoly industry structure, and whenever you have a it's a very classical Charlie Munger template that whenever you have oligopolistic industry structures, the profit pool of the industry expands significantly and it sustains over a long period of time. So it's a classical template to invest into companies which operate in an oligopoly industry structure. And that is something what I'm seeing emerging in segment after segment wherever these tech companies are operating in that sense. So this is one sector where I think valuation does not matter as long as you can pick the winners.
Got it. Pankaj, the next question is what everybody is grappling with. The impact, H-1B visa notwithstanding, the impact of AI-led pricing pressure that could come in onto Indian IT outsourcing companies, and whether that means that even if margins stay stable, does revenue growth lag, and therefore are these not investment candidates at the current valuations? What is your view?
Not really. I've spent the last 8 weeks meeting senior management and CEOs of 8 of the top 12 IT companies in India, and I've engaged. I've been part of some AI conferences and all of that. So I've been spending scratching my head quite a bit on all of this, and my inference still continues to be the same, that yes, there'll be efficiency gains that will emerge to IT companies because of AI implementation, which they will implement for customers, but before that, they'll implement in their own business in that sense. And companies will share gains out of those productivity or AI implementation with customers. But net on a 3-year, 5-year basis, I think AI will create more work for companies, and it will expand the addressable pool or TAM in the classical tech language for all IT services companies. I still hold that view that AI projects today are very small. Probably by the time the companies start spending or putting big dollars into AI projects, I still think that is 6 to 8 quarters away. But eventually that AI-led IT tech spend wave will be much larger than the largest wave we have seen in IT spends in the last 25 years, which was the internet wave of mid-90s and late 90s. AI-led IT spends will be much larger than that. In terms of where these companies, IT services companies stands in India, I think incrementally there are no further earnings downgrade. So earnings outlook is as good or as bad as it was 3 months back or 6 months back in April. Companies are not seeing any incremental downgrades. Yes, this is the third successive year of low growth from IT growth perspective. And once again, I'm saying in the last 28 years, I've seen the sector third successive year of slow IT spends globally. I'm seeing for the first time. So all I'm saying is, the point I'm saying is, if you look at the look at the Fortune 500 or the Fortune top 2,000 companies globally, they haven't spent on technology. They're holding back those dollars, but they cannot hold it for a long period of time. They will have to spend because the external world and technology is changing at a very rapid pace, and these companies will have to catch up with that. So my view is, investors, I don't know where exactly these stocks will bottom out, but anyone who's having a 2 to 3 year view, there can't be a better time to buying into these IT companies.
Just wonder, Pankaj, how you're looking at pharma. A big hit when that 100% tariff was announced, and then a belated reaction and understanding that a lot of pharma exporting companies from India are not going to be quite as impacted. Is this a space that you think has potential to unlock?
I think so. One, we've clearly seen what President Trump has announced on Thursday and Friday in terms of tariffs on patented drugs, if not manufactured in US. I think he's clearly spared generics, and I think he would not want to do anything with generics because there isn't any place in the world where you can manufacture generic drugs or molecules at a price lower than what you can manufacture in India. And eventually, if it does, you impose tariffs on that, eventually, if not immediately, eventually over a medium term, those will get passed on to US consumers. And that's one, area I don't think so I would like to touch. Having said that, valuations in pharma, the sector has done well over the last 3 or 4 years. Valuations, they're priced to, perfection, or they're reasonably priced. So I still think the sector has growth, but I think the best of the returns are behind us.
The returns are behind us on pharma. What is the one sector then where you think that uptick still remains?
I think consumption, and apart from playing direct consumer plays or playing through platforms, meaning a disclosure view on Swiggy there. And I think in a way, larger banks are also playing consumption, because if you look at the larger banks like HDFC Bank or a Kotak Bank or ICICI Bank, now 60% of their loan book is consumer loans, retail and consumer loans, and SMEs. So essentially, if there's going to be consumer spends and people are going to spend on buying durables across ACs, refrigerators, or buying cars, then they will be sitting on the balance sheet of these banks. One out of every 6 car that's there on Indian roads sits on balance sheet of HDFC Bank. So then if you want to play recovery in auto, probably HDFC Bank could be a great play on that, I would think. So I think domestic banks, and where valuations are also very reasonable, and one sector valuations are a significant discount to the Nifty index, and direct consumer play could be the sector to look forward to from a next, from a next 1 to 2 years perspective, and also from a next 6 months perspective, I would say.
Okay, thank you so much, Pankaj. Always a pleasure to speak with you, and the clarity that you bring to the table, especially when the market is so muddled and confused on, what to do and what direction to take. Pankaj Murarka there for you.